Welcome users to Wednesday on Wealth. My name is Mihir Shah, working as an Assistant Cluster Manager at Finto. Today we will be talking about inflation and the interest rate risk in India. Amid concerns over rising oil and commodity prices, over the last week we have seen a global sell-off. Fears of higher inflation may lead to derailment of global growth and which may lead to investors selling off. Food prices, which actually account for half the inflation basket, are also expected to be elevated. On the other hand, palm oil has already risen by 50% over the past year due to the supply chain disruptions that are currently taking place in the Russia-Ukraine war. First, we will be looking at the global scenario and talking about the US and what the Fed may do next. The US Fed is in a dilemma right now. Is inflation a bigger concern or should they still focus on growth? Since Fed's hawkish turn, there has been a tightening in the global economy. The recent spike in crude oil is stagflationary. Inflation being a major concern and purchasing power of consumers automatically decreasing, this stagflationary inflation may be a cause of concern. The question is, will now Fed worry towards the upside risk of inflation or the downside risk of growth? We think that there is a likelihood that the Fed will slowly start receding its hikes which we were previously expecting. Odds of a 50 basis point hike and 6 other have recently receded in the year of 2022, with the major reason being the Russia-Ukraine war. We will have to keep a very close eye on what the Fed does next, and the recent Fed meeting will be an important indicator of how the next few financial quarters are actually going to look like, and the global economy will surely be dependent on that. Jerome Powell has said that the rate hikes will be in increments of a quarter percentage point. However, he has said that if inflation poses a threat to the US economy, there can be higher rate hikes in the near future. We have also seen that yesterday the US data has come out and the inflation is at an all-time high of 8.5%. Previously, which was wavering around 6.5 to 7.5%, it is currently at 8.5%. Even in European countries, we have seen sharp inflation. This has led to inflation concerns in India as well. In India, not only are the risks to recovery rising, but current account deficit is a big cause of concern. Why? Because a sharp upward movement in crude oil prices may lead to widening of a current account deficit by 0.5 to 0.6%. If crude oil stays at $100 per barrel, there are chances that India's GDP growth may derail by about 1%. And also, in the recent times, we have seen the petrol prices increase by 10 to 15 rupees. This is purely because of the war that is going on and the uncertainty in the situation of how the crude oil would actually behave like. Russia being a major exporter of crude oil and India being a major importer, this has led to a sharp increase in petrol prices, and going forward, if the uncertainty remains, there are chances that there will be further rate hikes in terms of petrol prices as well. For India, growth could be hampered due to export slowdown and the uncertainty about the war that is going on. Also, the RBI recently in their latest monetary policy has said that the accommodative stance that is there on today would shift towards neutral stance going forward. They are expecting sharp rate hikes as per what Shaktikanta Das, our RBI chairman, has said. And also he has mentioned that the inflation has crossed the barrier of 6% and is currently wavering around the 6.5% mark to make sure that there is no further liquidity that remains in the market. This would in turn lead to lower purchasing power and lower demand and hence lead to inflation going down in the country. The RBI was very clear in what they were planning to do, and we should see now how the markets could react to such a statement. Like I said earlier, that we have seen over the last weeks that the market has seen a certain sell-off before a period where there was a sharp rise in the stock markets. Going forward, we are expecting to see some volatility in the markets and a side trend movement in the market is expected, especially in the case of India, where the war and other geopolitical tensions are playing a major role. Yes, inflation and interest rate risk is a concern. But on the other side, the positive side of things, we are seeing that the balance sheet of corporates and banks especially are in a much better shape than they were earlier. The valuations are also starting to look reasonable. When Nifty was at its peak about a year back, Nifty was trading at a PE of 23. Today, at the same Nifty, the PE is actually trading at 18. The valuations that were earlier there in the market due to the corrections that had taken place, Nifty has bounced back and the valuations as of today are pretty reasonable. What should an investor do in a market like this? It is important to stay on cash as there will be opportunities to enter the market. We're expecting it to be a very stock specific market, hence stock selection based on fundamental parameters is key. What an investor can do is take entry into quality stocks. This will make sure that the entry point is at a lower valuation, and we're expecting India to grow at a fast pace over the next 3 to 5 years. Yes, inflation and interest rate risk is a cause of concern in the short run, but once the war dies down, once there are rate hikes and inflation is under control, we are expecting a sharp growth in the Indian economy. Bond yields are also on the rise. In fact, in the US as well as in India, the bond yields are at an all-time high. This is another indicator that when bond yields are rising, equity markets tend to correct or move towards a side trend. This is what history has shown us, and we are expecting that history will be repeated. Hence, inflation can be under control. Interest rate risk, yes, is a cause of concern in the short run, but we request investors to stay invested in the market, but at the same time sit on cash. This would be an ideal strategy moving forward. So viewers, I hope this video was useful and informative. If you want to understand more, feel free to contact our experts, and also do like and subscribe to our YouTube channel for further such videos.